What's up, everyone? Welcome to Investing by the Numbers. I'm Simon Thompson, and today we're going to cover my Canadian dividend portfolio. This was a portfolio that I started building in late 2018, mostly built in 2019, and I'm going to show you exactly how I've been performing, all the good, bad, and the ugly of that. Plus, stay to the very end of the video because I'm going to discuss some key factors about whether I'm selling or I'm going to hold on for the ride, what my mentality was pre-crash. Okay, I did a pretty good job of preparing for things pre-crash, but there's some lessons there for me that I'd like to share with you. And then finally, we're going to discuss diversification, how I could have maybe diversified a little bit better going into the crash. So let's start taking just a quick view of my portfolio tracker. This is just a spreadsheet that I built quite a while ago. I'm sure I could use a much better tool that shows things a little bit easier for me and tracks things a little bit better, but this does the trick for me for now. And to be clear, I started investing in late 2018, and this just tracks my performance since then. So I'm actually down since then about 1% if you're not counting the dividends that I've reinvested since that time. So that's kind of actually money that has been put back in that wasn't my own cash. If you're looking at the total portfolio, including those dividends that are reinvested, I'm down 4.76% since that time. Of course, starting to invest in late 2018, not the best timing, but let's take a look at that quickly. Let's use an example, imagining if you had started investing in late 2006, similar to me investing in late 2018, and you're investing all this way, and then you continue to invest as it crashes. And of course, you have to have cash and cash flow in order to continue to do this. But let's imagine that you're investing here and here and here and here and all the way through, and you're investing through this whole process. 10 years later, when we really keep this in perspective, you are winning in a big way. You may be averaging in at this level at 1,200, and 10 years later, you have gone to almost double that. Plus, you've been collecting dividends that entire time at an increasing rate. So we just want to keep that long-term perspective in play. There was a time where I was down 16 or 17% in my portfolio at the very low of March there. And, it's not a number that I concern myself with because I have faith and confidence in the businesses that I own, and I think they will do well in the long term, and I'm betting on the success of North America in the long term. So I want to start by taking a look at the stocks that I've sold, okay? So there are some stocks that I've sold, mostly in my Canadian margin account and some in my TFSA. And these are stocks primarily that the fundamentals have changed for me, or when I did more research on them, I realized I didn't necessarily want to hold them. So just a quick exception to that is Brookfield Infrastructure Corp. This is recently the trust unit, the BIP.UN stock ended up spinning this off. Okay, Brookfield broke off a section of their business and turned it into another ticker symbol, and that split happened, and I just didn't fully understand what was going on. I didn't take the time, so I just sold that off and held my existing stake in Brookfield Infrastructure BIP.UN. So that's just that. So going back to our portfolio tracker, I just want to keep in mind that this number here, this loss number, is not such a concern to me, especially over the next 1 or 2 years, because there's potentially going to be a serious drop in the market in the future here. Of course, there may not be, but if there is, it's just an opportunity for me to invest. And also, I'm keeping that long-term perspective in mind. So I'm not bothered by these numbers here because these are unrealized losses, and I'm not going to sell these stocks unless the fundamentals on them change, and these are great businesses that I plan to hold for the long term. So quickly, let's start with talking about whether I'm selling stocks or not, and that's a good way to kick into that. So first and foremost, I've sold some stocks in my TFSA and I've sold some in my margin account. Now, some of these I've just taken some gains on, and then some of them, the fundamentals of the business have just changed, or I didn't like the business anymore, so I don't want to hold them necessarily for the long term, or maybe more specifically, at least in the next couple years in some cases, I'm a little bit concerned. So I've sold some stocks. So let's review a few of those. So Chesswood is one of the stocks that I sold. I didn't really get out at a great price necessarily. I was able to sell some of my stock up here, but also I was selling some of it down here in the $4 range. And basically, Chesswood leases equipment to small businesses, and my theory is that small businesses are going to get hammered a lot more than many other businesses, larger corporations that may get bailed out. And so I was concerned that they were going to cut their dividend, and they did. They've now cut their entire dividend. So this says 10.5% here, but actually it's 0. And I think they may be in trouble if the economy really suffers. So I think they're exposed more than other businesses, and I didn't want to hold on for the ride. So I own just a little bit of them still. And honestly, I think they may even go down back below $3.48. Next, I sold Chorus Aviation. So this is one that I sold in the low threes and sometimes a little bit higher than that. Again, this is a company, I really don't want to be a part of any aviation company right now. Chorus Aviation does short haul flights for Air Canada, and I do think that, within the country, type of flights are going to come back faster than large international flights. And Chorus may do okay in the long run, but I also think they may be in trouble. Flying, in my opinion, is going to be changed, at least for a year or two. And there's just too much uncertainty there. So it's a company that I'm not interested in picking up unless it's actually below $2. And then I think the risk reward starts to get interesting. So it'd have to go below its all-time lows for me to actually want to get on board, or potentially just have something change. And aviation's just not where I want to be playing right now. Another major one that I sold is Rogers Sugar. And it's actually a good company. The strong insider holdings, which I like. Their cash flow is good. I just don't see that they are going to be able to grow. I think their dividend is safe. I think they're just going to kind of meander down over time. And we can see here since 2017, they've kind of been doing that. It's just a competitive industry, the sugar business. It's a commodity. There's a lot of major players. And I also think that sugar as a trend is just going to go down over time. Of course, it'll always be there. It'll always be in our food in some shape or form. But more and more people are becoming conscious to the deleterious effects of sugar. So it's not something I want to bet on for the long term. So before we continue, please smash that like button. I hope you guys are enjoying this. I'm trying to be as transparent as I can and just show you the process that I've been going through in terms of how I'm managing my investments during this time and what my portfolio looks like. So I hope you guys appreciate it. Thank you for your support. Please subscribe and ringy ding dong those bells if you're enjoying this type of content. I talk a lot about dividend stocks and just investing in the stock market in general. So thank you so much for your support. So we can take a quick look at my portfolio and also touch on the idea of diversification. And you can see here that I largely own a lot of banks. Okay, banks make up about 30% of my portfolio. TD Bank makes up about 17%. I own it in my TFSA here as well as in my margin account. I also own quite a bit of Royal Bank of Canada. So these are just stable, dividend paying stocks. And of course, if we have a serious recession or even a depression, the Canadian banks could be exposed, but they're also very well managed, generally speaking, well regulated, and have good financial positions and have the ability to absorb shocks. First National is a company that originates mortgages. Fortis obviously is utility. Great-West Life is a life insurance company. Brookfield is a global infrastructure company. They own assets in data storage and in energy, and their utility as well. So you get a nice bit of diversity from Brookfield because they're in the global game. And scrolling down here, again, I just dabble in something like Aecon, which is one of the largest construction companies in Canada. I only really bought it because the price was so low, and I just got in, my toe in the water, so to speak, mainly for the fact that it was a low price in my opinion, and it's a cyclical type of business. So I'll sell it when the cycle seems to be over in terms of growth, maybe in 5 or 7 years from now. Anyways, I own still some Chesswood, which I explained earlier. Of course, I'm trying to build my position in Enbridge. I was buying it at 38, and since then it's kind of sailed up a little bit out of my price range at this point. What else? Nutrien is a company that is the largest potash producer in the world. I own a little bit of Rogers, a little bit of TELUS, a little bit of Bell. I'm trying to build my position in some of the telecommunication companies because they're just tend to be very stable during economic turmoil. So, essentially it's in energy and banking and telecommunications. So nothing too fancy. It's hard to get a massive amount of diversity in Canada, and that's partly because there's not as many major businesses doing interesting things. Like if we scroll down to my RRSP here, you're going to see that I have some US stocks that I'm starting to buy. I've bought a little bit of the banks, which again doesn't actually give me a huge amount of diversity, except for that it's a different country. Westpac Banking Corp is Australia's second largest bank, and they are listed on the New York Stock Exchange. Of course, I have Walgreens Boots Alliance, which is in the pharmacy world, and Prudential, also life insurance company there. But if we see some significant decline in prices, I'm going to try to diversify, and here's some of the businesses that I'm going to be researching and analyzing, trying to figure out what would be a good fit for my portfolio. And something like this, for example, Archer Daniels Midland Corporation, they're one of the world's largest food processors, and we just don't really have a business like that in Canada. I can't really get exposure to that industry without investing in the US. So if you are investing in the US in terms of dividend investing, make sure you're putting your investments in your RRSP if you're a Canadian, and that is because the withholding tax that usually happens does not happen in an RRSP just because of the treaty between the US and Canada. The RRSP is recognized as a retirement account and gets special treatment. So that's why I am trying to put all of these US stocks in my RRSP. Of course, the room is somewhat limited. I'm an entrepreneur. I haven't made a normalized income for a long time, so my RSP contribution room is not necessarily huge. Plus, I'm trying to hold a lot of my real estate investment trust stuff in there. So I'll talk about these really quickly too. I think Smart Centers is one of the best managed companies. I love the leader of it. But it may be in some trouble in the future here just because it's in retail, although I do believe they are in a good position, better than others. Choices, they're dealing with grocery stores primarily. I make a video on these three. You can check it out. It is the top REITs in Canada, so I'll link that below. One of them I don't talk about is Northwest Healthcare, and I think they are pretty well managed as well. They've been selling off a lot of assets recently to make sure they're in a good cash position, and healthcare is going to do well during this time. So just to wrap up here, I again want to just point out that what I'm really focused on is the long term. I don't want to be worried about where this portfolio net gain or loss goes in the next year or two, especially because there's going to be so much volatility, and that could go down. I could be down at minus 20% or whatever, but this just means I can put this cash to work and start investing and really execute on my plan. And so I'm really just trying to stay patient, and this is not the perfect portfolio by any means, but I think it's pretty good based on a lot of the principles that I have been learning and implementing in order to invest. And finally, I just want to touch on a couple of things before we wrap up here. To start with, this dividends reinvested number, I updated it for the purposes of this video. Started filming this video a few days ago, and I update this number every quarter or so, but I figured I would update it to where we're at right now since we're not at the end of a clear quarter. So I wanted to show you that. And then also this personal gain or loss number and the total portfolio net gain or loss number. This has changed a little bit since the few days ago that I started filming the first part of this. And I want to point out that I really don't pay any attention to this number. Over the next 5 to 10 years, these numbers will be very important. But going back to our example, imagining if we had started to invest in 2007 as compared to me investing in 2019 and building this portfolio then, it's very similar, right? So we may not see a huge upside in the next 2 or 3 years, but over the long term, if we're investing in great businesses, they're going to win, they're going to pay us dividends, and we will likely see significant growth. And so that also brings us to this idea of the weighted average dividend yield. And I expect this number to go up significantly if and when the market does go down again. I will be purchasing. And for companies that don't cut their dividend, that means they're going to be paying out a very substantial dividend. And so this number could go up into the 7% or even beyond levels. And that means that I'm about halfway to my 15% annualized return target. And of course, that's an average that I'm looking for over, a course of 5 or 10 years. But we're already starting to see some of these stocks paying out significantly more of a dividend yield just because their prices are so much lower. For example, I was buying Wells Fargo right around an average of $24 and $24 US there. And at that time, it was about a 7.88% dividend. Of course, that dividend could get cut temporarily, but more than likely it will come back to a similar level in just a couple of years, and then hopefully would be continuing to build on top of that. So ultimately, over time, as companies raise their dividends, if we go into another bull market after another year or two of dealing with a recession or depression, then we could see this weighted average dividend yield number really start to climb substantially as dividends may increase during that time. And so I just wanted to show you this also very quickly. Now it's May 28th. I started filming this a week or so ago, and now my portfolio is up 5.29%. So we've seen a 6% swing just in the course of, a week or 10 days. And again, this is why I'm not focused on where this number goes, because it can be up, it can be down. What I'm focused on is, are the companies in my portfolio, are the fundamentals sound, and are they going to be successful over 5 or 10 years? All right, I hope you enjoyed that inside look at my portfolio. And if you did, please hit that thumbs up button. I really appreciate the support. And of course, drop me a comment too. I love hearing from you guys. Let me know what you think of my portfolio, or you can let me know if you have your favorite stock that you think should be in there. I love hearing from you guys, so drop me a line. All right, let's just review kind of some of the key concepts and what we covered in this video. First of all, it's this idea of long-term thinking. So am I selling my portfolio? No. Even though my thesis is that I think that the market will go down eventually here, I don't know that to be true. And you can check out my video on my stock market prediction. I'll link it below. And you can see why I think that the stock market is more likely to go down, but I don't have a crystal ball. I don't know what's going to happen. And the portfolio that I have are companies that I believe in the long term, and over 5 or 10 years they'll perform well. So I'm not concerned about the fluctuations in the short term. And if prices go down, that's just another opportunity to buy more of those businesses, assuming that the fundamentals and the analysis doesn't change when I'm looking at them, like the ones that I did sell, right? So there are a few that I did sell because the landscape has just changed. The reasons to own them aren't quite there anymore. And of course, I did sell a few just to take some profits. And that is the small game that I'm playing that I could be totally wrong on. And that's why I don't really do much of that. I'm more of a long-term investor in general. And so we can also talk about pre-crash. As I discussed, I was keeping a lot of cash on the sidelines. Very fortunate to have sold my business about 2.5 years ago, and have been kind of waiting for this opportunity because I was aware that the bull market had to come to an end. But also, I wasn't going to sit with all of my cash on the sidelines because you just never know. So I've been investing, of course, and along the way, I think I did a fairly good job of being patient and waiting for opportunity, and I'm going to continue to do so. And then finally, diversification. I've been learning more about investing in gold and silver and commodities and some of these things that move not in direct proportion to stocks. And I think that's a place that I could have done a better job of being more diversified. And so that's a lesson for me to be learning as we move forward. But yeah, that's basically a wrap on the video, guys. If you want to learn more about how to analyze dividend stocks, you can check out my video, The 4 Time-Tested Principles on Analyzing Dividend Stocks. I think it'll really help if you're a bit newer or even if you're a seasoned investor, just because it really hammers on some core principles that are so important. And as always, you can check out my free guides below and learn how to invest in terms of building your mindset and your principles for analyzing stocks.